During the year, I think we'll be well in the hundreds on silver. Something very dramatic is going to happen, and it will not be incremental. I love it when I listen to the financial networks, and my son, Brett, monitors all the stuff going on the internet, the advisors there and so forth. And everybody, when silver drops hard, that's when you get news stories about it. It's rarely that they cite the fact that it's been exploding for quite a while, especially this past month. But when it drops big, there's the headlines, and so that draws everybody's attention. And there's all kinds of stories that surround silver, that some of which are true and some not, but about, this institution is going to do this, or this exchange is going to do that, and that's going to wreck the whole market, etc. You got to be aware that what's underneath this beast, in our assessment, and so far we're right, is that it's going to a new reality. Silver's not going to have another $50 up move out of the range from 0 to 50, basically for 50 years, and go up, and everybody's going to think around 100 naturally. That's the swing move, the dimension of the prior base. We think we're going to a new reality in the hundreds of dollars. And I think we're going to do it in about 6 months. Our clock started at the close of November. At that time, the price of silver was in the mid-50s. It was based on a signal we got from our relative performance analysis, spread chart analysis of silver versus gold versus the S&P, gold miners versus gold. All of these metrics said, we just shifted in a big way at a relative performance basis. When that occurred in 79, in the rush to the 1980 high, and in 2010 to the rush to the 2011 high, both big multiple gains in 6 months, that spread broke out, silver versus gold. We've had a situation since 2020, basically, of silver sort of underperforming gold. It's going up in price along with gold, but less so. And therefore, the spread relationship has been like a capped off. You broke through the cap at the November close. Now, and sure enough, if you use that as your metric, and it said, this is just the beginning of a massive shift of silver versus gold and also of net price, then the clock just began there. So it's not old, it's fresh. And our argument is, looking at lots of metrics.
Stop everything if you are watching the silver market. Veteran. Momentum analyst Michael Oliver is warning that silver is no longer behaving like a normal commodity and that small investors may be dangerously underestimating what comes next after decades trapped inside a range. Silver has entered what Oliver calls a new reality, one defined by explosive momentum, violent price swings, and no tolerance for hesitation. This is not a typical rally. It is not building a base. It is not offering clean. Instead, silver is snapping back instantly after erasing losses in hours, not weeks. Oliver says this behavior signals a structural breakout already underway, similar to 1979 and 2010, but potentially far more powerful tonight. We break down why silver is moving differently this time, why triple-digit prices are no longer theoretical, and why waiting for a safe entry may be the most expensive mistake small investors make.
Silver is likely in the next 6 months to minimum reach a couple $100, and possibly more than that, in going to a new reality. Not this 50-year range has been confined, in which most actually commodity markets have not been confined in that sort of range. Copper hasn't, lead hasn't, but silver has. And it's saying no more, okay? And it's not going to do it in a slow staircase, corrective process manner. So what we've stressed to our subscribers for some time is that you've got to somewhat ignore the type of events that we just had yesterday, which, usually it takes a week or so and you get a 10 or 15% pullback, and then it takes you a couple months to go up and take out that high. That's no, look back at October is a good example. We hit a high and we had a sharp break that lasted a couple weeks. Much of it occurred in the first week, but you couldn't get back to the high for about 3 or 4 weeks later. So you got whacked, But still, it was pretty fast recovery, given some of the other behavior of silver the last few years. This time, it was a 24-hour event. We went from a futures high at 82, dropped down almost to 70, and turned around today and hit 78. I mean, it didn't fool around. It didn't base. It didn't prove itself as support before it turned up. It just said, bam, back up, okay? In fact, we're back up trading now above the high close that occurred, high settlement price on Friday. So this is the kind of behavior that investors need to be aware of, that it is going to be part of this explosive advance, and just don't get upset by it. In fact, if you try to get out, the problem is getting back in, because sometimes it's not going to give you a nice base from which to buy from. It's just going to go whap right back up, and you'll say, what do I do now? So anybody who got out yesterday in the middle of that collapse, for example, is already behind if they buy back in. Don't get out. Now, in about 6 months, we'll be trying to define a place to then get out after silver has reached a new reality, because there will be major correction. It broke out last month. Forget the net price of silver or gold. Quit looking at their charts, okay? But when that relative performance spread broke out, it broke through a multi-year high of where silver had continually gone to bump against the price of gold, where it created a ceiling of resistance that it couldn't perform better than that level. When it broke through last month, silver's up $22 on the month. 1 month. It's already been in a bull market. Why did it suddenly go up $22 in 1 month? The spread said the game has changed. And I think the game will continue for a couple quarters. And once it's over, we'll look back and say, oh, golly, wish I were there. Well, the way to stay there is to stay long until certain metrics that we're monitoring say, okay, now we've maybe reached the level and probably even overshot a reality level. So if silver is justified to be a couple $100 an ounce, like if you take M2, money supply, and go back to 1980 and factor in the money growth, the depreciation in the buying power of the US dollar, and then calculate where silver might be a couple $100 probably. There's no question about that. But if that's where it's going, it's likely to overshoot it, as most markets do. If they've made a big mistake, they often overshoot the correction of the mistake. And so be ready for that. And there's another thing going on with silver that people seem to be focused on silver itself, like the industrial supply-demand deficit that's been around for 5 years now. You know, why didn't it work 3 years ago? Well, suddenly it's starting to work. Okay, well, you don't have enough silver to meet demand, especially high-tech demand. Everybody's focused on those aspects of silver. And also they're all panicked by the potential that, oh my gosh, the COMEX will raise, the CME will raise the margin requirement. Well, they've been raising it all along. I think it was like a 13% jump on Friday, in fact, where they raised the margin rate. And in 1980, the chairman of the COMEX, who I knew, because he'd trained me as at A.F. Hutton. I worked under him. He was the head of Hutton's commodity division in the mid-'70s. But he stayed the chairman of the COMEX till 1980, and he imposed no buying. Ceased buy orders. Silver's at $50 then. It had gone from about $3 to 50, okay? And the market crashed, okay? They think, oh, all they have to do is somebody on the outside, like in an exchange here or there, can push a button and stop this bull market. They don't realize what's really underneath the surface here. It's not merely exchange margin rates that are causing silver to go up too much. It's that industrial supply aspect, but it's also primarily the monetary issue. Silver is money. It's been money for 3,000 plus years, along with gold. The poor man's gold, and also money recognized by various governments, including ours at one point. So that is what's going on, and there's bigger issues that are underlying that continue to drive, for example, gold, is the issue of these dangers that exist and are about to implode and create even more central bank panic and printing. And that's the real driver under silver and gold.
To understand the warning Michael Oliver is issuing, we need to look beyond headlines and focus on structure. Oliver's central argument is that silver has not simply broken out in price, it has broken out in relative momentum, and that distinction matters. His work does not rely on news, sentiment, or short-term catalysts. It tracks how silver behaves relative to gold, equities, and mining shares over long cycles. According to Oliver, the critical moment was not when silver spiked into the 80s or violently sold off and rebounded within hours. The real signal occurred at the end of November, when silver decisively broke above a multi-year ceiling in its performance versus gold. For years, silver had lagged gold, rising alongside it, but consistently underperforming. That relationship acted as a cap. When that cap broke, Oliver argues, it marked the start of a new cycle, not the late stage of an old one. History supports this framework. Similar relative performance breakouts occurred in late 1979 and late 2010. In both cases, silver did not grind higher gradually. It accelerated violently, delivering multiple-fold gains within roughly 6 months. Those moves were marked by extreme volatility, sharp pullbacks, and sudden reversals that punished anyone attempting to trade in and out. Oliver believes the same dynamic is now in play. What has changed is the speed of the market. In past cycles, silver corrections unfolded over weeks. Today, they unfold in hours. A drop from the low 80s into the 70s, followed by a rapid rebound back toward prior highs, is not a sign of instability in Oliver's view. It is a sign of momentum compression, a market refusing to give participants time to reposition. This is why Oliver repeatedly warns against trying to step aside during sell-offs. In this phase, exits are easy, re-entries are not. The market no longer builds polite bases. It snaps back instantly, leaving former holders chasing higher prices. From a valuation standpoint, Oliver highlights how distorted silver remains relative to gold. Today, silver trades at roughly 1.5% of gold's price. In 2011, that figure exceeded 3%. In 1980, it reached more than 6%. Even a return to the 2011 relationship would imply a dramatic repricing of silver versus gold. Oliver challenges the assumption that historical extremes represent permanent ceilings. If silver has been artificially restrained for decades, the corrective move does not stop at fairness set overshoots. This concept is reinforced by analogs in other commodities. Copper and lead both spent decades trapped in narrow ranges before breaking out and rapidly establishing new price regimes that were multiples of their old averages. Once those transitions occurred, prices did not revert to the old reality. They stabilized at much higher levels. Oliver believes silver is undergoing the same process, but with an added monetary dimension. Silver is not only an industrial input, it is also a monetary metal with thousands of years of history. As confidence in government bonds weakens, long-term interest rates remain elevated, and central banks resort to liquidity injections. Capital searches for alternatives that are not dependent on policy credibility. In that environment, gold anchors the system, but silver amplifies the move. This is occurring alongside a structural supply deficit. For 5 consecutive years, global silver demand has exceeded supply. Industrial usage, particularly in solar, energy, semiconductors, and medical technology, continues to grow. Mining supply, meanwhile, is stagnant or declining. With few high-grade projects capable of responding quickly, Oliver stresses that exchange interventions and margin hikes are no longer sufficient to suppress this type of move. In 1980, buy orders were restricted outright, killing the rally. Today, margin increases have already accrued. Silver continues to surge. That tells him the driver is no longer leverage alone. It is structural demand combined with monetary stress. Looking forward, Oliver does not frame silver's future in terms of a single price target. Instead, he describes a transition from one valuation regime to another. In his words, silver is leaving a 50-year box and entering a new reality, measured not in incremental dollars, but in magnitude. If silver's inflation-adjusted value points toward the low hundreds, history suggests it will not stop there. Markets correcting long-term pricing errors often overshoot before stabilizing. For investors, the implication is clear. This is not a market that rewards perfect timing. It rewards understanding of momentum, patience through volatility, and recognition that violent price swings are not failures, they are features of regime change. Oliver's message to small investors is blunt. The breakout has already happened. The clock is running. And the longer participants wait for comfort, the further the market may move without them. This is not the end of a rally. It is the beginning of a repricing. And once markets enter that phase, they rarely offer second chances.